Hello guys, so I hope you all have, if not in SEO, still the recording, but we are continuing on what SEO we did. We did already investments one. Okay, today we pick up the second part of it, which was a continuation. This covers 6% of the entire syllabus for the CFA. Okay, so please bear in mind and fairly easy topic. Okay, we'll try and recap at the entire 1 and 2 at the end of the session. So this part will go on to natural resources, hedge funds, and we also look at digital assets. Obviously, this is one topic which was introduced in the recent 2 to 3 years after the Bitcoin surge, and the digital assets as a source of investment. Okay. Please give this topic importance because it's a newly added topic from the CFA curriculum. Under natural resources, obviously we cover all the natural assets. We look at demand supply diversification. Hedge funds, we look at strategies of hedge funds. It's like mutual fund, but they look at high net worth individuals. And digital assets obviously is blockchain and your typical bitcoins. Now, quickly, what you need to learn and be able to understand is what are features of my natural resources like raw land, timberland. Features, we'll understand the feature of commodities, how they differ. Let's try to understand the difference in the two. And very important, the risk, return, and diversification. How is that possible is very critical. Clear? So what exactly do I mean by natural resources? Okay, let's understand an overview, the features of natural resources and how it works. Now, natural resources are essentially, basically it's natural resources that are naturally available. Not something that's man-made, but more of God-made resources, right? So best example is land. The natural resource not made by people, it's made by God, it's naturally there and it's available, right? So raw land is something used for farming and timber, right? Real estate assets to an extent, infrastructure. It can also include inflation-protected securities, right? Now the key features of natural resources. Let's pick up one by one. Commodities, okay? Physical products, where you're looking at investing in something based on the quality, location. And remember, the returns could be in the form of, we discussed it, right? Real estate, rental income appreciation. For this, it is appreciation and not rental income, but probably interest income, dividend income. If you give it away on a short-term rent, then rental income. These commodities can be used for two things: price increase and income from various sources. Okay, but to bear in mind, commodities also need to be stored. So you may incur storage costs. So cost is not just purchase cost, but also storage costs. And the income is going to be income in the form of interest, rental, dividends, or any other benefit you're getting from the commodity by way of giving to someone else. Here, holding a commodity includes these costs we discussed, and therefore examples are oil, gas, copper, aluminum, gold, silver. These are commodities, right? The best example today, all of you know, is of silver, which is a commodity. It has gone up from almost 60K, 70K, 80K, 90K, it's almost 224K thousand, right? And that is obviously an example of price appreciation and obviously storing the commodity for the long term. Here, so this is indeed a source of income. Timberland, farmland. Okay, so land as a whole is also commodity or natural resources, sorry. Timberland, farmland, both offer income stream. Timber has basically timber like wood, right? And these obviously have a low correlation. Farmland is more for harvesting purposes like crops. So the main difference is farming purpose and this is for wood purposes. Remember Pushpa movie, right? That was the timberland where he used to harvest the timber from the forest and use that, right? So that's a timberland. Clear? Good. Now, let's look at commodities. What are the broad features of commodities? Now, what are the features of commodities per se? Okay. Now, commodities basically classification. They are metals. Okay. They are metals that can be used for various purposes. They are normally, if you buy contract, they are standard contracts defined by grade and quality. Example, let's say if you buy a Digi Gold, right, or Digi Silver. Now, a Digi Gold or Digi Silver is standard contract where the quality and the purity of the gold and silver will be standard. It won't be like 21, 18, it will be a standard 24 karat or 22 karat, right? And you can buy that, the purity is assured. So the grade quality will be standardized. Clear? The government influence, normally government has an influence on commodity dealing. You're aware of that. Government tends to have something like a minimum support price, right? Or they'll have subsidies. They'll allow people to make sure that they're getting a price support, right? To allow agricultural commodity to be sold at a price which is not which is not below the purchase, the making price. Government also regulates direct control. Example, oil and gas. It is regulated by government, and then there will be kiosks. So there is direct control of government over the natural resources and production of the natural resources. Right? Obviously, climate policy is also to make sure that you're not overusing it, you're not affecting the environment. All those features come as a part of my policies. Clear? Investment exposure, obviously, like as we discussed, you always can have two types of exposure. You can have a direct exposure and an indirect exposure. As we discussed in real estate, you can invest directly in real estate or you can invest through a REIT, R-E-I-T, right? In a commodity, you can invest directly by purchasing, let's say gold, silver, go buy the gold, silver, get an exposure to it, or you can get an exposure by purchasing derivatives. Correct? You can probably go and buy onion derivatives, wheat, bajra, you can buy a forward contract in any commodity which you can use. So obviously in commodities, forwards is the most popular because normally there is delivery trading when it comes to commodities like wheat, bajra, and so on. The key features of commodities is there's always a physical asset, right? Not like shares, but there's a they're digitalized, right? So we have demat form, but here it's physical. So therefore, there's a storage cost and transportation cost involved. In shares, you have to store the certificate or transport it, but here those costs are included. Therefore, the cost of commodity cost would normally be the purchase price plus the transportation plus the storage. Am I clear? That is how it works for commodities. Okay, we have exchange rate funds also, which are funds traded through exchange. Okay, alternative investment vehicles. Through that also you can track it. ETPs, ETFs, managed futures, SMAs, monitored assets, and specialized commodity funds. These are like mutual funds. We have funds which are specialized for only investing in commodities. Okay, they have a focused exposure, and their focus exposure is in the field of energy, metal, and agriculture. Is that clear? Okay, so this is broadly what we mean by the features and characteristics. Now, what you understand here, what you should remember is commodities are very different from the traditional investments, but also it's very different from even real estate, right? In real estate, you will not have futures and options. In commodities, you do have. In real estate, you will not have settlement through forward delivery, but here you have forward contracts. In real estate, you may not have government influence, but here you have government influence in the form of subsidies, price support, MSPs, and so on. So this is a very different niche market, very different market where if you want to invest, use it, you can do it, but you'll have to ensure that you are taking care of all the relevant other requirements. Okay? Commodity valuation. What is tricky is once you purchase the commodity, how do you value the commodity? Okay. Now, obviously, remember, commodities can also be valued through the forward and future contracts, through the options, and so on. Now, commodities have two prices, the spot price and the future price. Now, obviously, the price of the commodity today is always going to be lesser than the price in the future, right? Has to be, and they will be mostly be lesser, has to be 99% lesser. And the reason is obviously because of timing, but the more important is the cost of carrying model. Okay, now let's understand this concept. Why is the price today different from the price in the future, and why is it lesser? Let's understand that. Let's say I purchase a commodity today for a certain cost. What's the cost of commodity? Some purchase price. So your purchase price is what you incurred, correct? You will also potentially be incurring in the future transportation costs, right? and maybe storage cost, and you may be earning some sort of a yield from the commodity. Maybe if you rent it out, if you're on rentals, you give to someone, you want some dividend income. So your cost is nothing but what you paid plus what you use for transportation plus storage minus yield. So effectively your cost is not a purchase price, but all these costs, and this is your cost today in time one. In time zero. In time one, let's say after 1 year or 1 month, this total cost is going to be increasing by the interest rate for 1 year, right or wrong? And this is why the future cost, I'll call this future cost, is different from the spot cost. Because spot cost plus interest will give you future cost. Otherwise, there'll be arbitrage, right? So future price always has to be more than the spot price. Agree? So basically, we're going to market the both of the price today. You'll say 500. You go and find a forward contract. You say what's the forward price? You'll say it's 105, 107 because the interest rate is 7 or 5, right? Obviously, so the entire maths comes from future price, spot price plus interest, right? This is what you also learned in your quants, in your discounting. So this is the first formula called as future spot into 1 plus R. Obviously, I also told you, you'll wonder, I mentioned all of this to you, which is also not to be forgotten. So, future price is not just this, but also should include these variables also. So let me add transportation, let me add storage, let me minus convenience, and with I get my complete formula. Storage, transportation, convenience. What is convenience? Convenience is the benefit of holding the physical commodity, right? Clear? Now, obviously, you understand the logic. Future price has to be more than spot because future is spot plus interest plus transport plus storage minus. So future is bound to be more than spot, right? Common sense. So if the future is really more than spot, which is what it should be, the market is said to be in contango. But if you look at this formula, plus interest plus transport, there's also convenience yield. Now, what if the convenience yield is turning out to be much, much larger than the storage transport? I need interest rate to put together. What if this is so high for some reason? Let's say you have a very high yield on a certain commodity for 1 year. Then this spot cost minus the yield plus all this might become lesser than the spot price. So, in a position when the yield is very high, the future price might be lesser than the spot price, and that is called backwardation. It occurs when convenience yield is very, very high. Clear? Are we clear, guys? So, what we learned quickly? Future price is a function of spot price into 1 plus R plus transport, storage, and minus convenience. If the future price, which is normally greater than spot price, then it's contango. And that's because your yield is less, so these are all greater. If your future price turns out to be lesser than the spot, because yield is very high, so therefore it becomes a situation of backwardation. So understand what is contango market, what is backwardation. Contango is when it's higher, and backwardation going back is when the future price is lower. Here, guys. Okay. Obviously, in this contango, the long-run investors are earning lesser return. If it's backwardation, then the long-run investors are actually increasing their returns. Okay. Are we clear? Logic, guys, very important. So you learn the cost of carry model, which is future spot into 1 plus R transportation store. It's called cost of carry because you're carrying the commodity and find the future price. So that's called cost of carry. Here, and the yield will determine the contango and the backwardation situation. Clear? Any questions? Now, commodity prices and investments. Broadly, you have price drivers. Okay. Now, when you go prices, you have spot prices. You know that the price today is obviously it's a commodity like gold, silver also. Why is the silver price going up? Because the demand is going up. So it is always determined by the forces of demand and supply. Abhi demand is influenced by what? By the end use, by the users want it. Okay, even gold silver is going up because its users want it. It's a very see India, gold is in high demand, so gold price is going up. Silver price is also going up because of the production use, emotions, the anticipation. So all that is pushing silver price up. So the demand pushes the price influenced by end user value. Silver, the supply is obviously pushed by other factors like what is the production, what's the cost, what is the supply pattern, how many suppliers are in the market, what's the inventory value, what's the inventory availability, okay, how much is actually being produced to meet. You don't know that supply is less than demand, then obviously price goes up, right? And supply is dependent on all these factors effectively to decide demand versus supply. Clear? Obviously, in the short run, both of them, both demand and supply are relatively inelastic, correct? Therefore, in the short run, prices are always volatile. Clear? But as it reaches stability, then demand and supply become stable, as in they become less volatile and they achieve equilibrium. That's in the long run. Okay. Production risk obviously when people are producing, when supply are producing, there are other factors like weather, plant disease, rising costs, inflation, things which might affect your output, okay, are affecting your overall supply. Price expectations, people might expect that the price might go up and therefore they might probably increase or reduce the supply accordingly. Investors might sometimes assess what the inventory levels are. All these will affect your overall supply fraction. Return and portfolio role. Now, historically, we have always seen that there is higher returns and volatility in the commodity pricing than in stocks and bonds. Why? Because normally stocks and bonds are listed and they follow certain fundamental commodities. And I don't need to prove it to you. You know of late how the price of silver have been shooting up, right? It went up to 192, then fell to 150, then again it's gone to 225. There is a certain amount of volatility in commodities, gold, silver, copper, compared to stocks and bonds, right? There's a low correlation also with equities and bonds, but the biggest benefit is there is diversification benefit. Yep. Now, obviously, there's an effective inflation hedge. Okay, and obviously, example, as the inflation goes up, we also know that the price of gold and silver are also protecting you against inflation. Just like we discussed yesterday, real estate. Real estate also, when you buy it as the price go up in the market, the value of real estate also goes up. So you are protected against inflation by investing in commodities as well. Why? Because commodities have a positive relationship with inflation. Clear? Any questions? Okay, learn these carefully, make sure you are clear of the concept. Okay, so we discussed commodities, we discussed natural resources, we discussed some characteristics, features, and how do you invest and how they work. Okay, now guys, take up quickly 2 minutes again. Whoever's online, please look at this. Tell me what do you think is the answer based on the 3 options. Okay, work out the 3, take 2 minutes to read all the 3 questions and see what's the best possible answer. Take a minute more, guys. Look at all the options, right? So which are following most likely an attribute of timberland and farmland. Okay. Now, what's the answer? Anyone? Most likely. Can you increase the output? Can you increase the output? It is land, obviously natural resources. So you can't because the supply is limited. They cater to institutional investors. Is it? Yes or no? And is it relatively illiquid? What's the answer? Anyone online what's the answer from you guys? Okay, so basically, obviously it is more illiquid, it's finally land, right? And you can't buy and sell land, so therefore the answer is they are relatively illiquid. Okay? Mentioning that here. Institutional investor is not the option because most companies are for institutional investor as well. Whichever fall is least likely when net cost is negative. Net cost of carry means cost of carry minus convenience yield is negative. What is least likely? Least. Okay. Will it be backwardation? Yes, obviously we just discussed that. If net cost is negative, it goes backwards, so backwardation. Also, अगर backwardation में है तो contango में it can't be, right? And when it's net cost carries in backwardation, the long-term investors will earn a return. So backwardation, long-term earn, contango, long-term lose. So correct answer is contango. Here, which of all is least accurate about commodity returns? So you think of what is more accurate first, okay? Think of what's accurate returns and what is being higher for commodities, right or wrong? Yes, that's the right answer. Timberland, farmland have lower volatility as compared to global stock returns. Timberland, land is more illiquid and therefore the volatility is much lesser, probably because commodity prices center of negative correlation inflation rates. Do they have a negative correlation or positive correlation? These are having a positive correlation with inflation rates. So this statement is wrong. Holding commodities can act as a hedge of inflation risk. This is actually a right statement, but this negative is wrong. The answer is, so these two are correct. This is wrong, and therefore this is the right choice because they said least accurate. Okay. So remember, guys, from an exam point of view, please try to understand that in the exam, right? In the exam, you should be able to try and choose the right answer by thinking beyond it. If they say least accurate, you think what is most accurate. And your most accurate, you click you get the answer least accurate also, right? So try to pick up the answer based on the options that are already available. Clear? Okay. So you found these two are accurate, therefore this is least accurate, and therefore that's the right answer. Okay. So that was all about commodities and natural resources. Okay. Now let's go on to hedge funds. Now hedge funds, a very tricky topic. Hedge funds are entirely like mutual funds, right? But here they invest in niche investments and they deal with high net worth investments. So let's try to understand what are the features of hedge funds, what are the vehicles, and obviously risk returns and the diversification benefits by using hedge funds. Okay. Now, hedge funds as a tool, as an investment, they obviously don't get hedge funds as using hedge. That was never there. That's never the understanding. Hedge funds basically came to a long time back. They had started using hedge as a means of making returns. But today, that's not the main reason it's called hedge funds. These basically deal with high net worth. Okay, they use both long and short portion. They don't just deal only on long. They look at both, and they can obviously they may hedge the risk or they may keep it open. But trust me, they are high risk, high return. Okay, their goal is to earn as much possible. They are completely aggressively managed. Okay, obviously they want most returns, so therefore they also tend to use leverage. They use both long and short, and obviously long and short position taken by use of derivatives. Right? Hedge funds will not work as per your instructions. They will have their own set of data research, and they won't follow your investment instructions. They'll follow their own set of this set methodology. Okay, normally they are set up with very few investors. Not a mutual fund where you have 1,000 or 10,000 investors. This is just a few investors. They will not allow them to just redeem when they want. They'll hold them up and they'll give them a lockup period. If you want to breach the lockup period, you have to give a notice and then you can redeem because they are invested in such highly illiquid investment that they can't just suddenly redeem it and go. They have to stay invested for 2 years, 3 years, 5 years, and then they will make almost 4x or 5x of the returns. Is that clear? So hedge funds are very unique type of investment vehicle. Okay, they are the broad characteristics. What are the risk features of hedge funds? Now, remember, I told you the high risk, high return. Look at what the risk is. They typically exposed to much higher risk, okay, than your traditional investments, obviously, which means mutual funds. They have a much higher risk. And the reason is the cash flows are uncertain, not just the timing, but the amount. The leverage is used. They will not just invest your money, they'll borrow money. Obviously, borrowing money includes interest, and interest is a high cost, right? What they invest in does not have a simple value. So they may go and invest in, let's say, a Flipkart. Now, Flipkart is not listed, right? So how do you get the value of Flipkart? They may invest in Myntra. They may invest in private company. They may have some stake in some private big companies, right? Because before Swiggy came into listed, they invested in Swiggy as well, Zomato, and then they took it to IPO. So they'll invest in all these funds, in all these investments, where valuation is a challenge. Why is it a challenge? There is no observable market price. Clear? Obviously, they have a very complex fee structure, taxes, accounting. That's quite complicated. They will not be having a straightforward structure per se, right? And their returns should ideally be risk adjusted because they have a high risk. So the returns also should be potentially higher. Okay. Evaluate returns. Now, what is very important to understand is I have to look at risk and returns together because you can't say, oh, wow, the hedge fund gave me 40% return. That's awesome. You can't say that because the risk must be almost 25, which is very high. So 40 returns is not so great for a risk of 25. You will want the returns that match the risk, right? So risk return matching is very critical. And that, if it's not considered, that can be misleading. Yeah. Okay. So hedge funds are normally high risk, high return vehicles, and you'll always find there's a root cause for that. Okay. Now, what are the broad hedge fund strategies? How do they work? Okay. What are strategies for hedge funds? Now, hedge fund strategies normally work as equity hedge, event driven, relative value, and macro. Just understand each of this carefully. They are a little critical. Okay. Broadly, when it are hedge funds, they invest through some of these strategies that is driving their investment mantra. Okay. These strategies are exclusively to hedge funds. You will not see mutual funds picking up any of these strategies. What exactly are these strategies? Okay. Now, equity hedge. Let's look at the left side. Equity hedge. Equity hedge. It is a bottom-up approach where they're trying to invest. Now, bottom up. At the bottom, they look at investment securities. They will try to look at securities which are undervalued. Okay. And they'll try to find out which are undervalued, they'll take a long, and which is overvalued, they'll take a short. Yeah. So why it's called bottom up? Because they start at the security. If you say top down, it starts at the country, economy, then the industry, and then the security. Bottom will look at security first. I don't care which country, which security, which theme, which industry. Okay. Now, then they'll do, obviously, when they do a market neutral, they look at only valuation. If they do look fundamental growth, they apply fundamental analysis. And they'll try to find out those companies which have a growth story or an appreciation story. Which companies have growth and appreciation? And that is fundamental growth, which will allow them to invest. Okay. They can also use fundamental analysis to analyze and find out undervalued security. Okay. Obviously, then they'll go long. They can use quantitative techniques. Quantitative techniques will also help them to understand which ones are over undervalued. When they do technical, they probably do some of P ratio. They do some pricing. They look at the pricing chart. If the price is going like this, like this, like this, like this, then they realize that, okay, this is when I should buy, this is to sell, buy. They look at the movement and they try to figure out the points on the direction of the price movement. Yeah. Short bias, they can also look at short portions on overvalued stocks. Sector specific is where they'll focus on a specific fund sector. Let's say today now, of late, railway sector has been in the news for some, because they have increased price by a few 10 rupees and something. So railway sector has boomed in the last 1 week. So they can take a sector specific focus and try to invest in that sector, right? So these are the various types of ways that do equity hedge. Basically, equity hedge means taking stocks in equity by using certain techniques like fundamental, quantitative, short bias, fundamental growth, market neutral, and so on. Clear? Equity hedge. Now, the next one, so that is equity hedge on one strategy. Strategy number 2, market or event driven. Event driven means they are driven by event that is probably announced in the market. Now, when an event or something is announced in the market, they will enter the market and they'll take action based on that event because that event would drive the prices either up or down. That is called event driven investing. Here, example. Let's say a merger is announced, like for your back, IDFC Bank and IDFC Limited, they merged, right, to become one. L&T, Mindtree, L&T, Mindtree became one, right? So when a merger happens, what do they do as a part of arbitrage? They will buy the target company and sell the acquirer company. So if IDFC Limited is buying IDFC Bank, they will buy the IDFC Bank because that's a target company and they'll short the IDFC Limited. Why? Because they believe that when a merger takes place, the target company price will always benefit and the acquiring company will always lose. This is what the fund of the game is. So therefore, they assume that because this is likely to happen, they'll buy more and more share of target companies as being merged and they'll try to sell the acquiring company because the target company is going to have synergy benefits. And synergy will give value. Yeah. So the one you have to do a merger arbitrage. Obviously, if you realize there's a ratio and the ratio should be followed and so on and so. Example, now the biggest merger that you can think of is the cement industry, right? You have Ambuja Cement, ACC, Orient Cements, they are merging to become one. So they're giving shares of Ambuja to all these companies. So you should probably try to conserve buying the target companies and selling the acquirer company to make a merger arbitrage. Yeah? Distressed restructuring is the son we spoke yesterday where you are investing in distressed or also bankrupt companies. Distressed companies will always give a turnaround. If they give a turnaround, then you're going to earn almost 5x returns. Clear? So that's also inventory because you know the event is a distress. Go to NCLT, pick it up and buy the shares. Activist companies where you act as an activist, you are probably buying 10%, 20% stake and you sit on the board of directors, you're sitting on the decision making and you're able to take decisions that will influence the company's overall decision making. Okay. Obviously, you can become an activist only when you get a significant equity investment stake. And to do that, you have to be able to buy that much amount of shares. Clear? Special situations obviously means other special situations where you have say share issuance or asset sales and so on, where you can buy or sell these shares. Yeah. So event driven is where certain events are announced and you are taking action based on those events to make a profit in the market. Okay. Followed by hedge fund. So we have equity hedge and we have event driven. Okay. These are two of the strategies. Let's move on to more. Any question on this? We have relative value. Now, relative value is basically where you are using the relative valuation of the company, right? What the relative values, what's the value should be. You're using that to find out where is the mispricing and you're trying to buy sell. Now your example, now you're comparing values, say fixed income convertible. You're trying to find out what is the mispricing between the convertible bond and the options. In the sense, let's say I have a bond that converts into shares. What's the value of the bond today? And what's the value of the bond plus the shares that I'll get in the future? So you're trying to find out the value of the convertible bond and the value of the additional option I'll get with the bond, right? And then you'll see what is more preferable. Fixed income asset backed, where you have notes. Fixed income, these notes are issued. You will find the mispricing among the ABS, MBS. You will find out where are these assets, these securities, where are they undervalued or overvalued, and you'll try to then long them or short them. Obviously, how do you know this? By looking at the market scenario, what is the portfolio value, what is the real estate value, and then you'll see how much is the ABS, MBS portfolio value, and you can buy and sell accordingly. Fixing, but be careful, this is one of the reasons why the subprime crisis happened in 2008, and this is why this is the area of focus. Okay. Fixed income in general, find the relatives within fixed income securities. Use options to, play with market volatility. When a market volatility goes up, you might want to short options and make money. If the volatility is very low, you can long options and make money on the premium side. Okay. Now, obviously, all this relative, one more relative added value. Normally, PE is a relative, right? This is a relative value. So you can take the PE value, multiply by the company's EPS, and find out what is the market price of the company. Then you compare it to the actual market price. You compare to the market. If the market is showing more than this, then you can probably say sell. If the market is less, you say, boss, this is value buy because the price should have been 100. The market is only 90. Let me buy it in the market. If this is 100, but the market is showing 120, you say, let me sell it. So you can use the relative valuation methods, formulas to actually understand whether I should go long or short on certain stocks by looking at the derived fundamental values. Here, okay. Then obviously you have macros where you do. So it's a relative valuation. Macros you do. Now when we discuss the bottom-up approach, you have a top-down approach. Top. So on the top, you look at what is the economy. You look at the country. You look at the industry. Okay. Then you look at the company. So you will go from top to bottom, right? You look at the economy. Let's say I want to invest in USA, which country, which industry, which theme, marketing, banking, production, and then you pick up the right companies, right? Now with AI, everyone's crazy for Nvidia stocks. Probably Tesla is going up. You look at AI stock and you see how it is performing, right? You have to take position across fixed income, equity, currency, and commodities. Clear? So this is how the hedge fund strategies are. Okay, the key strategies which help the hedge funds to actually make more profits than other funds. Okay, now the biggest reasons why some of those hedge funds are obviously high risk, high return. But obviously, you'll see the people who invest in hedge funds are people those who are having the risk appetite to actually invest in those shares, right? Now, one of the main benefits of hedge funds is there's a low correlation. Okay, obviously, this low correlation is very important because it gives you diversification. If the other stocks are going up, hedge funds normally will not go up in the same direction. It may go down, it may stay up, it may go higher. It depends. If this goes down, hedge fund may still go up. So hedge funds are a good diversification benefit tool. Okay. Very important to understand is that hedge funds normally give you returns in any market. Because bull hai, then they'll go long, they'll do strategies. Agar bear market hai, they'll go short and they'll still make money for you based on options, futures, forwards. They'll short and they'll make money. So they're very active in both market. Remember, hedge funds are actively involved. Obviously, it doesn't mean that you go invest because they still have a very high risk appetite. But they normally give absolute returns in all markets, right? While we say they were invested in high liquid, but they could provide liquidity. And hedge funds are normally arbitrage players, means they identify all the arbitrage opportunities and they sweep in. And they swoop in and they make sure that arbitrage is contained. Like we saw the merger arbitrage, right? The merger situation. Every arbitrage situation is taken care of by hedge funds. Okay, so correlation is low, they are diversification, absolute returns in all markets. What is the risk of hedge funds? The correlation will always increase. Now, low correlation is good, but if there is a crisis, the correlation will go up, and that high correlation will end up in no diversification. So that's a slight problem. Comparison is difficult among hedge funds. Remember, hedge funds is not regulated highly, because hedge funds are normally invested in by people who are having a high net worth and people who are not too concerned about regulations and rules and oversight. All they want is high returns, high risk, high return. So hedge funds are not like mutual funds that are regulated. These funds have almost no regulation at the level that they are performing. Clear? So that's one of the biggest risks, obviously, but they still have their own rules and policy that they follow, and the people trust the hedge funds for that reason. Is that clear? Any questions when it comes to hedge funds? So I hope you know what hedge funds are. Please understand mutual funds versus hedge funds is a huge difference, right? Risk, return, all of them, mutual funds are much lower compared to hedge funds. But this is regulated, highly regulated. That is why people still invest in mutual funds. Here, the regulation is very low, correct? And people who are having a high risk appetite will go here. But we know that risk return is always low for mutual funds, which is the best part. Here. So therefore, you'll see in India, I think hedge fund is not so popular. It's only the people who have a lot of spare money, millions of dollars or crores of rupees, they will invest, because even if the returns are negative or they lose the money, they'll not really bother too much because they are high risk individuals. Clear with that, guys? So that's how the hedge fund market works. Clear? Okay, let's quickly look at some questions to cover this up on hedge funds. Look at the option, guys. Read this and see how the questions are. So, all the question here. And investor wants to invest in hedge fund that engages in convertible bond arbitrage. Right? Would most appropriately select what type of fund? Relative value study fund, special situation fund, or a separately managed account? Convertible bond arbitrage. So what's he looking at? Convertible bond arbitrage, right? So he's trying to look at the valuation of the convertible portion and the bond portion, correct? So if I look at relative valuation relative to the value of the underlying option, correct? There's nothing called special, there's also event driven. So make sure the words are correct. And SME is fine, but not institution. An investor chooses a fund of funds as an alternative to a single hedge fund. So fund of funds is where he's using multiple funds, like ETF, Digi Silver, Digi Gold, UTI, and so on. Various funds he's mixing up, or he's taking a single hedge fund. What will he benefit most likely from? Okay, lower fees, higher return, manager expertise was the answer. So you know that single hedge funds always have a high risk, high return, correct? So high risk, high return. So obviously not this. Potentially expertise, most of single hedge funds, they have a high return, high risk, high fees. So normally it will be lower fees in terms of fund of funds. Normally, okay. Hedge funds use leverage to magnify which of the following? So they normally said they use leverage, right? They magnify what? What they want to increase. They want to enhance the overall returns, right? They want to increase the returns. So are they increasing risk? No. They want to increase the risk. They want to basically increase the alpha, which is the excess return. Alpha is the extra return that they're making over and above the normal return. Yeah. So leverage, remember we mentioned yesterday how leverage is nothing but the borrowing that you use. You borrow money, correct? At whatever, let's say 12%. That way your return, you normally would have made 20%, it will now become 28%. Your return goes up because you borrowed at a lower cost. So you're magnifying your overall alpha. Clear? So potential answer could also be for manager experience. Okay, so convertible bonds. In convertible bonds, we have A, relative valuation, special situation is not the option. Okay, your alpha, learn alpha is nothing but excess return. Alpha is normally what you earn minus what you expected to earn, extra returns. Okay, and your choose of funds, not high returns because this is high returns normally. But in this, you have fund of funds, you have multiple funds, you have many funds, and therefore you'll have many managers also. And therefore, in this option, manager experience will probably increase. In single fund, you'll have a single manager. So potentially you'll have more manager expertise in a fund of funds. Lower fees probably is an option in both, right? But they said most likely So most likely the answer is A and C, but most likely would be manager expertise. Okay. Lower fees could not be an option because sometimes fund of funds will have multiple funds and multiple fees. So just be careful. When they use the word most likely, you want to find out which is most likely going to happen. And the answer is A and C, but this is more likely because of multiple managers. Clear? Okay. So that is your experience and learning with hedge funds. Okay. So we covered natural hedge funds and others. See, investing in funds of funds may provide more diversification, more man experience, but not more returns because there is additional layer of fees. Because there are multiple funds, multiple managers, and maybe multiple fees, and therefore the returns might be slightly lower. And but the other big thing is hedge funds already have a high risk, high return model, so obviously the fees will not be, the returns will be much higher. Okay, so you're not using high returns, but you'll have multiple managed experience. Today, normally a fund of funds is always a better option because of the fact there's a diversification benefit. There are multiple layers, there are multiple funds, there are multiple industries, and there is more diversification across various sectors. Okay, so that is what I mean by fund of funds. Okay, now the biggest and the most important topic, which is digital assets. It will take almost 40 minutes to 1 hour since we're there for. I think we just a quick break here, guys, and then we resume for the next part because this is all about, if you know, I mean, this is what you probably know and has seen. This is all about bitcoins and digital. So this is those assets. Obviously, even DG gold, DG silver, right? You'll notice off late has become a big thing. It's boomed a lot because in the world of digital assets now, this is becoming a huge requirement, right? So digital assets, when I say that, I'm talking about those assets that are not physical, right? Which is like my physical commodities, but those assets which are in digitalized form. Okay, so I'm talking about digital. Okay, so even digi gold, digi silver, all of these will form a part of my digital assets. So what is happening here? Today, people are investing the assets because they want to reduce the cost of physical cost and carry. Okay, so this will take a while. So let's probably take a break and come back. Okay, let's take a quick 10 minutes. Let's just resume at around 11:55, guys. Okay, and we'll meet for digital assets, and then we'll recap the entire alternate investments. So quickly, what are key learnings from digital assets that we want to look at? Describing what are the financial applications of digital. This is a little tricky. Don't worry about the detailed technical knowledge. You don't need to be technical experts at this. Remember, from a CFA point of view, well, if you're trying to get you to understand what exactly are these class of assets, how do you use this as a part of your entire portfolio management, right? And essentially understanding how this can be a part of a portfolio, and you can diversify by using the correlation benefits of this along with the other assets, right? We look at also the investment features as usual. And remember, guys, one common thing that you want to essentially make sure you understand is risk, return, diversification. You'll notice this is the last topic obviously in audited. You'll notice that everything I'm doing, all the topics I'm doing, I'm commonly covering risk, return, and diversification of that specific asset class with all the other assets, including traditional and non-traditional investments, right? So when you're studying this entire module of foreign investments, please ensure you guys learn, comprehend, and apply the knowledge of the risk and returns of that asset class and how it forms a part of your portfolio to give you the desired diversification. Okay, they are the key learning objectives of this of every topic within all the investments, which they are likely to test you on from a CFA level. So please get your mastery on that aspect of the topic. Here, you notice that's a key learning outcome that's common for all the subtopics within alternative investments. Clear? And like if you remember my first lecture, I told you always look at learning outcome statements and ensure that all the learning outcomes that are highlighted in your CFA curriculum at the start of every topic is understood in detail. Okay, because the question that they ask will also be linking back to your learning outcomes. Clear? Okay, so let's start. Now, what are digital assets? What's the broad features? What's the definition? Digital assets are those which are digitally created, digitally stored, and digitally exchanged, right? If I give a simple example, Digi Gold, right? Digi Gold, Digi Silver. Digi Gold, Digi Silver are also not dealing with physical gold, right? They deal with gold and silver in a digital form. What do? You click the app, you buy, let's say, 1 kg silver. You will not get the physical silver at your doorstep. You're not even going to take the silver and go store in a locker. All that you'll do is you get digital certificate that you own 1 kg silver of a certain purity, of a certain value. That's it. You do not get the physical gold. So therefore, this investment is digitally created by you, digitally stored in your account. And if you want to sell tomorrow, all you have to do is click the button and digitally sell it also. You're digitally exchanging it for value. That's how easy it is. I mean, in fact, honestly, that's the best way, because imagine if you buy physical silver, then you'll go to a shop, they'll verify the purity, they'll test it, they'll check it. All that is dispensed of when I look at Digi Silver. Same for digital gold. They will look at what the purity, what the making charges, what is the amount of, is it 22 cat, 24 cat, 20? They'll not check all that. You have your certification on a digital format and it will get the value which is consistent, standardized. How easy is that? Okay. So today, honestly, guys, we are in the age of digital assets. Okay. And honestly, more than half of the investments in gold and silver are starting to take form in digital form today. People don't go and invest in gold, silver physically, right? Obviously, those who are looking for maybe long-term storing will probably do that. But if an investor wants to add it to his portfolio, he will probably do it at a click of a button in a digital format. If you Google, you'll see there are so many digi gold, digi silver, UTI, ETFs. There are so many of them, right? Obviously, these are how the digital assets work, right? So what is it? Digitally created, digitally stored, and digitally exchanged also. Yep. These encompass cryptos, we discussed it, bitcoins, tokens, digital collectibles. Now, cryptos and all are normally validated through distributed ledger technology, DLT. Okay, so how the Bitcoin works is you have a technology which is having ledgers that distributed across networks, and there's a coding, encoding, there's a password, and so on. So we call that as DLT technology. Clear? Now, what is DLT in more detail? A decentralized distributed, right? So it's a decentralized record of all the transactions. Okay. And what happens is there's a security that is maintained, because obviously I want to make sure that the value of Bitcoin is huge. So there has to be security, and the password is normally known to only you, right? There is complete transparency, there's accuracy. You will have the details of it on your password. It'll be all encrypted, decrypted, and you'll be able to look at it and transfer it through the system. The ownership also can be very rapidly transferred, not like physically go to a shop, find the right price and so on. It's rapid at a click of a button. Okay. Normally it is peer-to-peer interactions. You don't have to interact with the direct customer, with the physical buyer. Disadvantage obviously is data protection concerns, right? Obviously, if someone hacks into it, right, that's a bit of a problem. So that's a disadvantage, protection. There can be potential privacy violations as well, okay, and high computing power requirements. You'll notice, example, Bitcoins, you must have heard of so many stories where people have lost their password to the Bitcoin and they're not able to find the password. Now things like Bitcoins and all, that the password, when you don't get the password in the minimum number of attempts, then that will probably be compromised. It will disappear. So that is the extent of security they've given. But obviously, you have to ensure that you do not misplace it. You do not lose it. That's one of the probably the biggest disadvantages. Obviously, hackers have been trying to get hold of these digital assets by, hacking the network. So that's one concern. Privacy depends on to what extent you are able, your privacy is being compromised, and obviously high computational power requirements, which is more specific to Bitcoins. Okay, so that's how the DLT works. There's obviously a lot of mechanisms to place to ensure that there's security. Now, if I was to define a DLT network, a DLT network, right, distributed ledger technology, it has a ledger which again is distributed across the network. The ledger is in digital format. Okay, there are a number of participants in the network, and there's a consensus among all the participants, which is why you have to make sure that when you buy and sell, you do through a network of participants, and they will agree, and then you encode it, decode it, pass it on to the next person. Okay, they utilize cryptography. So when you buy and sell, so basically something like this, data is here. Okay, data is stored. This data is protected. Okay, how is it protected? Through encryption. So when you encrypt the data, right, this data is then stored. Now later, if I want to remove the data, I want to access it, I will decrypt it. The decryption key and code is known only to me. So I can decrypt the data and then take it forward. So there's encryption happening and there's decryption happening. Encryption, decryption is nothing but my cryptography. Okay, and everyone knows what encryption, decryption is, right? Hopefully, it happens to even data. Let's say you have some important data on a laptop, and your laptop gets stolen. Your data cannot be accessed if it is in encrypted format, which means the person can probably see the data, but he can't access the data. He'll have to put the decryption code, right? And this is where hackers come to play. This is where the FBI, CBI will take laptops. They'll always be able to decrypt it because they have codes for decrypting, right? But apart from that, the cryptography helps the data to be secured so that only the owner can use and access the data. Okay, so cryptography is very, very critical. Okay, now within these bitcoins, you have smart contracts where they are basically self-executing computer programs. These contracts for bitcoins are made through computer programs, and these contracts are then prepared and moved on ahead. Okay, now cryptography follows the blockchain technology. Now, what is blockchain? Again, blockchain is specific to bitcoins and other coins. It's a type of DLT. Now, remember, it's not the DLT, it's only a type of DLT. Within blockchain, information is sequentially stored and recorded within blocks. And these blocks are linked together using different techniques. So basically, you'll have blocks which are connected. These blocks are secure, and the data is sequentially recorded within these blocks of Bitcoin. That is why it's called blockchain. Because you can see this is a chain of blocks, and each block contains information that is encrypted within that chain. Clear? So therefore we say blockchain technology, information secured within the chains of blocks. Are we clear? And these are linked together using cryptographic technology. Are we clear? Okay, I think I'm going too detailed, but just understand broadly how that works in the world of blockchain technology. And that's it. Don't go into too extra detail. You have to be expert on it. Get the way that it's secure. Understand it's secure. There's proper confidentiality. They ensure privacy, and then making sure that hackers don't hack into your systems, into your data. Okay. Now, what is the consensus protocol? So basically, Within this, there are certain protocols that are being maintained where people are able to work with each other and get added and move. With this consensus mechanism, blocks, obviously blocks are added to the blockchain, right? Which I mentioned, few blocks get added, and there's a proof of work. So if you're aware how cryptography works, basically you're doing mining, right? So miners will use computers, they'll solve complex problems, they'll verify the transactions, and as miners keep working on it, they use computers, they create more blocks, and that's how the bitcoins potentially will get created, right? So the proof of work and also proof of stake. Proof of stake is where all the network participants, right, they will pledge their stake to guarantee the validity of every block. So remember, when blocks are being created, right, by miners, when they're creating the data, these blocks will need to be validated by stake, by collateral, putting the collateral as part of stake. So therefore, there are two things here. There's a proof of work, which is the miners doing the work and mining the data, and the proof of stake, which is when the data is created, the people put their collateral to or the stake to validate that data. Okay, so that's how the bitcoins potentially will be created. So it requires the consensus protocol of all the people involved in the network. Okay, DLT, distributed ledger technology through blockchain. Now, if you look at forms of DLT network, okay, within the forms of DLT network, we have, these are certain forms. We have permissionless networks. Okay, now networks where you don't need specific permissions from a super user, right? Transactions are happening beyond the network. These are visible to all the users. Anyone, obviously anyone who has a Bitcoin can buy and sell. They can see which Bitcoins are being bought, sold. They are able to see all the transactions take place, okay, on the network. They're able to view it, and therefore they're able to also see what the price is, and they can execute a transaction on that network if they have the technology. Yep. Obviously, this is Bitcoin. So the best advantage, the biggest advantage is when you follow this technology, there is complete privacy, confidentiality, but there's also complete transparency. There's accuracy. You can actually able to command the best price. When you look at, okay, what is going on, what are transactions, you are able to also decide whether to buy or sell and look at the price movement, look at demand supply, and accordingly you can decide how you want to execute your transaction. So that's the biggest benefit. And you can actually confirm your transaction because remember I told you it's a consensual protocol. So everyone's consensus on that Bitcoin, on that technology is required, right? So people can either confirm or deny the trade. So that's where it is so highly secured, right? And that mechanism helps to people to actually be able to be protected, okay? And that's a big advantage. Obviously, this is within permissionless networks, but don't forget, permissionless still means that you have to confirm the trade. There is consensus involved. Permission networks, okay? Now within permission networks, the users on that network will have to get some amount of permissions. They are restricted. Okay, they'll have to acquire. It's like how you enter a WhatsApp group, right? You still have to get the admin's approval maybe to be added to groups. You have permission networks, right? So think of it as a WhatsApp group where I want to be able to enter the network. I want to be able to enter the group. I'll have to get permission from the admin, or I don't need permission to enter. So here you have permission to enter a network, and obviously you will have to ensure that you are known. You have your stake. You have your passwords in place. Okay. Now, obviously, permission networks are more effective, they're more useful, and it helps control the traffic and monitor the traffic of users within the system. Okay. These are also more cost effective, right? Because you're actually controlling the traffic and making sure that only those people who are relevant and have the permissions are within the overall network. Yeah. So under DLT, we have permissionless and we have permission network. Again, don't be mistaken that permissionless has no security or the lesser. That's not the case. It's just about making sure that people can enter and see the network and see the transactions without taking the specific permission. That's only difference. Okay. Now, performance appraisal. Now, if you want to understand how do you appraise the performance of alternative investments, right? How does it work basically? So one is, I mean, this is also known for traditional investments. You have two types of investments. You have passive, where a person makes investments, leaves it and watches it grow. Like example, you purchase Digi Silver or you purchase Reliance shares, traditional alternative, and you leave it there and you let it grow as the market is moving, right? That is called passive. You not touch it, you're letting it boom. Passive. Active is where you are purchasing something and you're watching the movement. You actively watch your movement. As the maybe a share price, maybe as the share price goes up, you'll probably want to consider selling. Maybe as it goes down, you'll say, okay, I'm going to buy at this point. If it goes again up, you'll sell. So this is where you're actively trying to enter, exit the market at strategic points. This is called active. Okay. Now, obviously, there's no right or wrong answer. You can't say active is better than passive or passive is better than active because many of it, if you're doing active, you're selling, you're buying, you're selling, you're making a much higher profit, right? Instead of just standing here and making money only when it goes here. Because in past active, you're trying to get benefits of the rise and fall. But the problem is you may not end up buying or selling at the right price. What if you decide to sell here because your field is falling and then it goes up and you probably should buy here? So it's very difficult and dangerous to do active when you're not clear of the trend index. So this is where the CFA knowledge is more useful. You should be able to gauge and decide whether I'll do active or passive, right? So these are the two types. Obviously, there's no third type of trading, and it's your decision to see whether I want to pursue an active or a passive trading strategy. Okay. Now there are a few risks that are present. Okay, and these risks can be both. If you do a standalone investment or you look at a portfolio, you'll always have certain risk. Okay. Now, what is the broad risk? You have limited transparency. Obviously, always you'll have to ensure that transparency is there, but sometimes you'll have transparency might be limited, may not be. Example, you can't see the exact price of Bitcoins that goes up down every time. You can't see the exact price of the insider trades or profile trades and so on. Transparency might be limited. Sometimes there will be low liquidity at a portfolio level, right? That's a risk. That's a risk that you can't immediately sell. Example, let's say MRF share, it's around 1.5 lakh, 1.6 lakh. You can't immediately sell it because the liquidity is potentially low, right? So that's always going to exist. Active or leverage. Sometimes you're using leverage, you're using a borrowing, right? You borrowed money at probably 10, 12%. You have to ensure that you earn more than the 12% to offset the cost of borrowing. And that's dangerous, right? Because let's say you are already able to make 8 or 10%, then borrowing at 12% is useless. Because remember, leverage will magnify your profits, but it will also magnify your losses. So leverage is a very dangerous game, right? And this active or leverage can be a risk, right? General strategy, product complexity. If the product is so complex that you don't understand the product details, you don't understand features, or how it works, even that can be a risk for you. General challenges of manager differentiation, diversification. Sometimes managers might have a different strategy. Every manager might have a different strategy, right? They may differentiate among products. That is also a risk. Why do you think every manager makes the same amount of profit? Because every manager has their own experience, their own judgment, and they have their own differentiation strategy. Diversification, it's a big challenge. You can never ever say you're diversified, right? Because once the market goes down, everything will tend to go down, right? Obviously, in this case, gold and silver is a diversity benefit because if the market goes down, then the gold silver goes up. But obviously, even that tends to follow its own movement. But yes, That is a big challenge because not everything can be totally diversified. Right? That's a challenge. That's a risk. Mark-to-market issues for a portfolio with niche specialized products because somebody have to mark to market, right? So how do you mark to market when there's no ready value available or if there's no observable value? So marking to market could be an issue when the product, and normally this is more for alternative investments, you cannot mark to market on a regular basis. So that becomes a challenge. Here, we discuss how you have redemption issues. Not every mutual fund, hedge fund, example hedge fund, you can't redeem. You have to stay locked in for a period of 5 to 7 years. So you have limited redemption availability, right? And portfolio pressures for eventual redemption activities. And obviously, fee drags associated with alternate investments are also one aspect where basically there's a fee drag you have to probably pay. You know, sometimes pay a higher fees, sometimes maybe non-trivial, but you have to ensure that this risk is also considered and taken care of. Yeah. So there are a few risks that you'll see are present in most investment portfolios and on standalone portfolio basis. Yeah. Now, the main thing, the question that you've probably been waiting for, 15, I mentioned a few times, what are the various types of digital assets, right? We discussed about cryptos, bitcoins, altcoins, central bank digital currencies, right? Dollars, pounds, altcoins are stable coins, meme coins, bitcoins, you know the name. You have tokens also. You have NFT tokens. All of you guys are probably more familiar with the security tokens, utility tokens. These tokens are also created and they are in digital format. They're bought and sold, right, on the market. So even those will work as certain digital assets, right? These are digital assets that you can consider. So why we discuss on it first now? In the world of portfolio investment, you should be able to demonstrate that your portfolio contains a mix of these digital assets to ensure that you are able to effectively diversify the risk in the portfolio. Yep. So we have bitcoins, altcoins, CBDCs, and so on. Tokens obviously are becoming also a little bit popular now. You have NFTs, non-fungible tokens, and so on. If I compare my digital assets, okay, with the other asset classes, and we did some of this yesterday, we did real estate asset classes, we did shares, debentures. If I was to compare the key differences between these two, what are the differences in them? Digital assets, they lack a cash flow. You don't see a Bitcoin or something giving you a cash flow. Like it will not give you interest income or dividend income or rental. They will not give you that, right? Real estate probably will give you rental income, right? Shares give you dividend. Others give you interest. But these will not give you a cash flow. And that is a problem. That is a big difference also. Fundamental worth. Can you find out what is the fundamental worth of a Bitcoin? You can't. It's all about demand supply. So these assets don't even have a fundamental worth to it. If I ask you the fundamental worth of real estate, you say, fine, it is my rental income over the next 5 years, 10 years, plus the price appreciation, plus the value. You can find that out. You can find a worth for real estate, for shares, for certificates, for debentures. You can find fundamental worth. But for a Bitcoin, and I say Bitcoin because that's a digital asset, there's no fundamental worth to it, right? And fundamental worth means the present value of future cash flows, or maybe the cash flow expected, or maybe what's the price earnings ratio, what's the earnings per share, what's the fundamental price. You can't find that out. Very difficult. And that's a big difference. Okay. Variance in transaction valuation. This is very interesting. The valuations, I mean, you've probably seen how they'll vary. You might have a sale recorded 1 lakh, next sale at 9,000, next sale 1 lakh 20. Well, it varies. It varies, obviously not so high, but it varies. Even silver to next year, you see silver sold at 2 lakh 30, 232, 225. The variation is crazy. I mean, it's huge, it's large. And that is where you'll see there's a huge variation happening in the valuation of these transactions. Clear? Listing medium exchange, obviously, okay, this is very distinct from other asset classes, okay, and mostly these happen on an online basis, right? Now, but one thing I understand, like cryptocurrency, there are restrictions, right? I mean, you know, in India already, RBI has at some level banned the cryptocurrency. They said, no, you can't be trading. They said, okay, you can trade it. Now, people in India are more hesitant because there's some sort of restrictions to deal in bitcoins. They're also asking users to declare the bitcoins on the IT portal. Any returns made on bitcoins are being charged at a different tax rate. So they're doing all that because they are having certain restrictions that are being imposed on the potential cryptocurrency usage. Okay. And that is where it's a little bit difficult to ensure that you understand that these are things that are different from your typical asset class. They will not restrict you from buying real estate or sharing on, but cryptocurrency and all, there are restrictions because of obviously the boom and the fact that it's not physical, it's digital format, secure and so on. Divergence regulations. Even today, you'll probably not find established standards or you'll see it is still unregulated. Can you go to the stock exchange and place an order for Bitcoin? You can't do that. There's no regulated exchange per se. Obviously, there are one or two, but many of them did collapse also, right? There was a fluctuation in CDX and so on. So the exchange is still not fully and properly regulated as it should be. There are no established standards for governing. Forget standard governance. There are no proper accounting standards also for accounting for investments in bitcoins and in digital assets. So all this goes to show that the market is still premature. It's not fully active. It's not fully there, and that is where these are still yet to be something that's fully functional. Okay, so regulation and diversion, I would say, is completely absent. There's no regulation by regulators. There's no proper regulated India today. Like there should be a separate regulator, right? We have SEBI for stock exchange. We don't have a separate regulator for bitcoins or digital currency, right? So these are the key differences, which are not just also differences, but these are also a challenge when you deal with this kind of alternative investments. Yeah. Any questions? I hope you guys can read the slides while I'm discussing. Please read this carefully, guys, and you'll see the number of points are limited because there's a lot of depth into this. This is a very difficult topic because there's one topic where there's less words but more understanding expected from you, and it's not so easy, trust me. And being a new topic, they are bound to test you on this. Out of the 6 questions they'll ask you, they're likely to ask you at least 2 or 3 questions, likely from this bitcoins, cryptocurrencies, or from digital assets itself. So please be as prepared as possible and learn and understand carefully. Okay. Now, cryptocurrencies trading platform. Okay. Now, the exchanges that are there for, so you can obviously trade. Now again, the markets not, but because the CFA US exam, the markets are not so mature and not so well established and regulated in India as yet. But in USA, there is still a better market, right? That's why in USA, they are, regulating the flow, the demand supply, the transaction much higher, right? But basically, if you look at it in crypto trading platform, there are 2 exchanges. One is a centralized exchange and decentralized exchange, second one. So in the central exchange, okay, as you can see, it's privately owned. Okay, it's all centralized and there's a proper sharing of data, the pricing is shared, and the volume is happening on that. Okay, so the centralized stock exchange, okay, on one central platform, everyone will buy and sell their cryptocurrencies. Now, obviously, being centralized, it is more popular and more widely used than obviously decentralized because there's probably more users, there's more volume, and the biggest advantage is there's more transparency. Okay, these are obviously by direct electronic trading on the private servers. Now, if I come to decentralized exchanges, where this is decentralized, it is spread out, and obviously DLT is a good example, decentralized ledger technology. They enforce blockchain principles. They don't have a central authority. Without central authority, right? They will operate on a distributed framework. Correct? That's why I call it a distributed ledger technology. They will operate on a distributed framework through the distributed ledger technology, and they'll be decentralized to that extent. Okay. So centralized platform will have tightly owned, transparent pricing, volume. This will be decentralized, spread out, having ledger technologies spread across various forums, and that's where it will be coming. Okay. When you go to now cryptocurrency investments, okay. Now obviously you can do direct purchase. You can purchase it directly, okay. Which even you can purchase bitcoins become a member of the exchange, put your credentials, put a purchase, and you can record and validate all transactions where they will put you on the blockchain. Remember, we said there's consensus among the members. You'll be a part of the member participants. There'll be a consensus, and you can validate your transactions, right, using the POS status. Remember, we discussed the POS status for that of stake, right? And you can also purchase any of your NFT tokens, trade tokens. You can directly invest in that instead of going through a fund. Obviously, today I don't need any mutual fund or something that does, because obviously in India it's banned. They can't be doing it. But abroad will probably have such funds. But you're actually able to get a direct exposure by purchasing the currencies, trade FPs, and so on. Now, there is a risk. There's a risk because the market is not fully mature. There's a risk of fraud. Maybe there could be fraudulent ICOs in the market. There is obviously a risk of market manipulation and theft, obviously. Theft, hacking, wallet, credential breaches, right? Because see, Bitcoins are not physically there, nor is it digital. It is normally in your wallet, right? So digital assets will be in a digi wallet. So in your digi wallet, you will have Bitcoins and other assets in your digi wallet, and your wallet will have the credentials that you have the passwords for. If the credentials are obviously breached, then obviously the wallet becomes exposed, right? And therefore people might take. Now this wallet, just like the wallet you have in your pocket. So you have like Paytm is also a wallet, right? In that you have the money stored. So same way, this digital wallet will be stored with the relevant Bitcoins, NFTs, and so on, and you can buy and sell. If it is breached, if someone gets the credentials to your wallet, or someone is able to hack into your wallet, then the problem is that you could have a theft taking place. That is why it's a fraud risk. Clear? This is not the case in a demat, because in a demat, no one can enter a demat account and sell. He will still, if he sells or buys whatever someone does, it will still go to your account, right? With it all mapped to your account. But here, it is possible that the user goes into your technology DLT, buying, sells, uses and cycles of the Bitcoins to his own account. That is possible, right? So, wallet credential breaches, theft, robbery is more likely, and that's a huge fraud risk for such assets. Any questions, guys? All this is when you go through the direct investment route, right? Can you invest indirectly? Yes, you can. Obviously, everything has a direct and indirect route. If you want to invest indirectly, you can do it through trust. Like a mutual fund, you'll have trust, which are basically buying shares, buying the cryptocurrency in large amounts. So you can probably invest money in the trust, and the trust will pull the money from various people and invest it into cryptocurrency amounts. Yep. You could also get exposure by not just to trust, but also entry into futures or forwards, right? Now, future forwards is basically, I hope you know what it is in derivatives, we learned it. It's where you enter into a transaction to buy or sell at a future date, correct? You're buying or selling what? A specific cryptocurrency. You can say, I want to buy 5 Bitcoins at this price. That's a future forward. Based on that, the price movement, you will get the exposure. Okay. You could also go through exchange traded products. A better word in India, we say exchange traded funds, ETFs. Everyone knows about what ETFs is. When you deal exchange traded funds of ETFs or ETPs, you are replicating exactly. You will effectively get the same return that the underlying asset will give you. Example, like I told you at the start, I discuss later. If you buy a Digi Silver ETF, or the exchange rate product. As the silver price goes up, your ETF value will also go up. So same as the Bitcoin, if you want to go for Bitcoin exchange rate product, as the Bitcoin underlying price keeps moving up or down, similarly, the value of your ETF, of your investment will also go up and down. You're not buying a physical asset. You're simply buying an ETF, which will replicate the movement of the price of the underlying asset. Replicates the price of the underlying asset, right? So I say returns or the price. Clear? Okay. Now cryptocurrency stocks, obviously, these are stocks which are linked to your cryptocurrency. Again, you can get the same exposure, you get returns based on your underlying assets as they move up or down. Okay. Now, like Nvidia, right? Nvidia is AI and they have some exposure to AI. So, and maybe some cryptocurrencies. You can have an investment companies which are doing cryptocurrencies, okay, which have business ties to the assets which are in digital form, right? Cryptocurrency hedge funds, best example, right? Now, you know, we discussed in the earlier part of the chapter, hedge funds have no restriction. They can probably do long, they'll do short. They also sit and deal in cryptocurrencies where they'll probably do certain strategies. They'll do discretionary, they can do event driven, they can do arbitrage, they can do long short, they can have quantitative techniques. They will look at the movement, and these people effectively will deal in cryptocurrencies as a part of strategy. If you want to invest in this hedge fund, cryptocurrency hedge fund, which will allow you to make money on the movements in the underlying assets. Clear? Okay. So what you learned potentially is I can invest in these cryptocurrencies both through the direct medium, right, by directly purchasing it, or indirect medium by going through trust funds, ETFs, or even derivative positions. Now, derivatives is normally one very standard way of getting an index exposure in anything, even commodities. I can do derivatives. Real estate also I can do derivatives, right? I can do REITs or derivatives. So everywhere you can get index exposure by looking at derivatives. Digitalization of non-digital assets. Now there are certain non-digital assets, okay, which can be digitalized as well. So these are basically, okay, asset-backed tokens, which will now it could be possible that the asset itself is non-digital, but I can digitalize it and convert it into a digital asset for the purpose of transactions and purchase or selling, right? So we have asset-backed tokens. Now, example. Now, these are tokens which are backed by certain assets, right? And these tokens will be basically representing the assets that they're backing. They're representing the ownership, right, of the underlying physical assets digitally. Ownership of that underlying asset. Clear? That's how they will work. They're secured by the underlying asset as well. Okay? And they potentially enhance the liquidity of the high value asset. Obviously, it's useful because that physical asset buying sold will probably be more illiquid. But if the asset is probably sold in digital format through an asset class, it can more easily be bought and sold. So having them in digital form is always going to end up enhancing the liquidity of these assets. Okay. It also enables immutable ownership records, and these are mostly categorized as securities. All right. So these asset-backed tokens is how essentially these will be worked out. Here, digitalization of the non-digital assets. Okay. Now, this is exactly how digital gold, silver also works, right? They are backed by the gold and silver. They represent ownership of the physical asset, right? And they are secured by the underlying asset. So the value of a digi-silver is because it is secured by the underlying silver or gold. And that's how it works. And it is easier to sell the digital silver than to sell the physical silver, right? I mean, obviously, physical is also easy, but you have to go find the best price, look at various cuts and so on. So liquidity is better enhanced when you are able to digitalize all these assets. So remember, guys, even if the asset non-digital, it is always a better option to consider looking at digitalizing them and dealing with these digital assets per se. Okay, and you're also able to have ownership records of the assets which cannot be challenged. Okay. So these are securities, right? And these are part of portfolio. As a portfolio manager in the CFA curriculum, you should be able to include such digital assets within your overall security. Yeah. So digital assets is here to stay. There's a lot more to it than we can consider. Okay. And remember one. Yeah. And remember, these will always be a part of your overall testing pattern. Yeah. Okay, let's quickly look at these questions. Solve 1 and 2 for me, guys, quickly. See the answer. Tell me what's the answer 1 and 2. Have you worked it out? In contrast with traditional assets, right? Traditional is this is alternative investments. So with traditional assets, digital assets. Now remember, it's most likely, right? So most likely they're going to happen. What is it? Are not typically backed by underlying asset cash flows, have established regulatory guidance in most jurisdictions. Is that right? Is there any guidance? Not really. Not like traditional assets. Are there account file ledgers maintained by central intermediaries, private ledgers, or is it distributed ledgers? Are not typically backed by underlying asset cash flows. What's the answer? Distributed ledgers, not private, they're not this. So potentially the answer would be not typically backed. So if you look at traditional assets like shares, debentures, they are backed. Shares on dividend income, debentures on interest income. So there are certain cash flows that will follow it. But if you come to digital assets, they are not backed by cash flows from the underlying digital asset. Tell me, Adip, you use digital silver or digigold. Do you have a cash flow from digisilver or digigold? Not really, right? There's no cash flow from an asset, right? So the answer would be potentially A, right? Question 1. Oh, it's 1A. Yeah. Most are not backed by underlying cash flows. Okay. Obviously, they don't have any raised standards and they are typically recorded not on private ledgers but on decentralized digital ledgers. Clear? Let's look at question number 2. Mainstream financial systems are hesitant to accept cryptocurrency reaction due to which factor? Why are they not accepting cryptocurrencies? Why? Do they have a low transaction cost? Obviously not. They don't have a low, they have a high transaction cost in fact, right? Lack of crypto roadblocks in several countries. Other way around, many countries have roadblocks, right? So roadblocks are not lacking. In fact, there's a, like India also, they are not really accepting. But is cryptocurrency legal tender in many countries? Not at all. Cryptocurrency today, I don't think any country, obviously USA, UK, there are some transactions they have done. I remember in UK there was a house. Someone purchased a house in UK by using cryptocurrencies. So people are using cryptocurrencies as a medium of purchase, right? So it is used in some countries, but obviously it is not at all popular and it is not considered legal currency in countries, barring one or two, and that too barring a few transactions. So therefore, that's the right answer. It cannot be considered as a medium of exchange, right? Which of following statements, take your time to read this, is most accurate regarding centralized and decentralized cryptocurrency exchanges? Decentralized exchanges are prevalent, centralized are more highly regulated, or is less? Which is most accurate? Most. Are decentralized prevalent type of cryptocurrency exchange? Is it highly prevalent? Are centralized more regulated? Not really. Central decentralized both are equally regulated, right? You have a doubt on this? Let's come back to that. Decentralized are less susceptible to network attacks. Yes or no? So decentralized are like Bitcoin, you'll have the networks, decentralized, they are less susceptible. Obviously, they have the network sharing, they have the password encryption. And decentralized are not the prevalent type. You will have centralized also. Okay. So the answer is more likely and most accurate. The answer is decentralized are less susceptible to network attacks. Okay. That's the most accuracy. Okay, quickly guys, last two questions. Read this. Tell you what the answer is. If we wrap up this topic on alternative investments. Come on guys, take your time, read this. Let's understand the rationale behind why you got this answer. So what's the answer here? An example of a digital form of investment in a non-digital asset. So digital form of investment, right? In an asset which is non-digital is what? Asset-backed token, cryptocurrency exchange rate product, or purchasing tokens on a cryptocurrency exchange. So you purchase tokens, potentially it is direct, right? Cryptocurrency exchange rate product, which is a product that is traded on the exchange, right? Cryptocurrency and an asset-backed token, a token which is backed by an asset. Was the right answer? Tricky one, right? Little tricky. But this is about digitalizing the non-digital asset. Right? I'm digitalizing an asset which is not in digital form. So what's the potential answer? Right? Looks like it could be more of an asset-backed token. What the answers you guys have? Potentially 4, right? I think it should be that. Yeah. Okay. So an asset-backed token represents digital ownership of a physical asset, right? Which is a token out here. It's a non-digital asset that is being digitalized through the token. Clear? So the token is digital, but the asset is a non-digital asset out here. Right? And like I told you, cryptocurrency is indirect exposure, right? And cryptocurrency and purchasing digital assets are direct exposure, right? So this is indirect, that is direct, and the first one is a classic case of digitalization of a non-digital asset. Clear? The main driver of cryptocurrency values is what? What's the answer here? What drives cryptocurrency's values? As in, why do people invest and what drives the value? Is it low price volatility, asset appreciation, or unlimited supply of cryptocurrencies? Do you really think there's unlimited supply? Right? Definitely not. Cryptocurrencies, in fact, if the supply unlimited will not be coming up, it's gone to almost $1 lakh and above, right? There's no unlimited supply. It's something that's being mined, right? Is there a low price volatility? Definitely not. Cryptocurrencies are highly volatile, and you'll see the prices are booming, going up, going down, right? They've gone from 20,000, 30,000, 40,000, $1 lakh, 1,20,000, gone back to $80,000. There's a high volatility. Obviously, which also means that there's only one answer. But cryptocurrencies, like all other alternative assets, has price appreciation. Clear? That's the main aspect. Yeah. No, come to 7th row, no. I just wait for 1 minute to stand up, no. I'm still in the class. Just wait, tell them to wait down instead of wait for 1 minute and come up to 7, okay? Yeah, right. Clear? So there is asset appreciation out here, and that is where the main driver of cryptocurrency values goes. Okay. See, now these are questions you need to learn. So while you have the knowledge of the topic, please start understanding how to solve the questions. Please learn how to do that. Okay, example here. I mean, maybe this was an answer, but even this. So if you don't know, well, thank you. If you don't know what is the main driver, then you try to apply your knowledge in terms of which is eliminated here, and that will help you get a better understanding. Correct? Volatility definitely you know is not the answer. Another holy sector. So aspirant is the right answer. Clear? So let's quickly look at a quick example. Like I said, please learn. I mentioned yesterday also, but please learn to understand why the other answers are not correct as well. This had helped me a lot years back when I take the exam CFA. I remember I used to always look at solving sums and trying to understand the rationale behind the right and wrong answers. So, every practice I used to do, every question should take me at least 10 minutes. Not because I took time to solve the answers, it's because I took time to understand the answers and the logic. So, even though you might have got the right answer at times, please try to understand. And this is where Schweitzer and the Institute of Materials is very good. They'll explain thoroughly the reasons for the answer, right? So, example one, this one. We have said fine, right? Cryptocurrency value based value as appreciation. Why? Because these assets have no underlying cash flows. अभी cash flows है ही नहीं तो क्या होगा? Appreciation. That's the only reason you're earning, right? If you're buying real estate, you're not looking at only appreciation. You're looking at real estate cash flows and appreciation. So understand that why is it as appreciation? Because that's the only thing you'll get without cash flows. Then they also explain very well why the other answers are not correct. And this is where I wanted to learn, because in the exam, this same question may not come, but an examiner's question may come. They may twist the question, ask a different question. So at least you're prepared with three types of questions when you learn this one question. When they say supply is limited, this is important that you understand. That is why the price goes up, right? So when they say supply is unlimited to the boss, that's a wrong statement. And try to understand, okay, supply is limited, therefore the demand pushes up the price, right? At the pushes, because supply is almost the same, constant. If the supply is constant, price will keep going up with demand increasing, right? So this is a very important line for a different type of question that they ask in the exam. And that is what you should prepare with. So every question will have three answers that will resonate with you. Clear? Cryptocurrencies exhibit extreme price. This is another learning which you should have learned by now. This is why is the price volatile. Now, this is also important because investors are uncertain. Cryptocurrency are not a certain cash flow, right? So investors are only uncertain about it. So therefore, the prices are highly volatile. And be wary of this aspect also. Okay. And this high amount of volatility is driven by investor sentiments and uncertainty. Clear? So learn the way these answers are actually written. Clear? Don't just study, see the answer, move on. Every answer should be an investment because you're studying. Example in this one, asset-backed token different digital. So you know that, you understand that that's non-digital asset, you're digitalizing your non-digital asset. But what are other ones? Do you understand that exchange rate product is indirect? Learn that. Indirect is where you're doing an investment through an ETF or ETP. If you're purchasing, you're doing direct. So understand, cement your knowledge. Okay, direct is purchasing, indirect is buying through a mutual fund, through a hedge fund, through a ETF. So understand the concept, be clear on it. So that any other question that's testing your knowledge on direct, indirect will meet with the same response from you. That is critical. Sorted? Okay. So invest your time, and the question that we given you in the class, in the notes, are following the same pattern. For decentralized, we say multiple. What is decentralized? In case you forgot, think of it. It's multiple computers, that is decentralized, right? So obviously, if you have multiple computers, what's the biggest benefit? If any one is attacked, what will happen? It will be operational. If I have a centralized system, right, and that one system is attacked, then everything is boom, compromised. But here, if it's decentralized and even if one is attacked, then the others are going to continue. So therefore, attacks on decentralized are more difficult. So try to understand the logic behind the answer, because that will make you remember the answer rather than trying to study the answer by rote. Don't say that decentralized is more secure. That's it. Don't study that aspect. Study the reason behind it. Are you getting it? Where in the exam they ask you, okay, centralized exchanges are more vulnerable. Why? And they'll have options. Then you should be able to answer, okay, central because if one attack, then the entire system becomes non-operational. That is what you should prepare with. Don't prepare yourself for this question alone. Prepare yourself for variations of this question, which will help you ace the exams. Are we clear? And that's why I like every question I read it. I prefer to understand the options. See, here they also said, however, select a prevalent type of exchange. So they said decentralized is actually prevalent with centralized. Even though they are more unsecured, they're still a prevalent type, and both obviously lack, which you already know. So that's fine. You already know it well. You're sorted. So don't go further into that. Okay. Okay. Are we clear this? And the other one, first hesitant to accept cryptocurrency. Obviously, we already know this. This answer is simple, right? You knew it's not acceptable. So this answer is fine. That is sorted. Yeah. So wherever it's easy, it's too easy, you know the answer, don't. But you'll see these have very good logic to it, which actually work. Most villas are not backed by assets. We already know that. And we also know that they lack well-developed standards. We know that bit. Okay. So understand every answer and please remember to do a thorough reading of the options. When you have the institute materials, even there, the reading is very detailed. Okay. So please understand the logic and the rationale for it. Clear? Okay. So with that, we now end our session on digital assets, on alternate investment. Any questions, guys? Okay. So with that, we wrap up this entire module on alternate investments, right? The notes are available. Please go through the videos carefully and please ensure you guys actually understand it. This is one topic that is not too easy to understand, and also one topic which I said has been introduced of late. So please go through it carefully and get your learning around it. Okay, fine. Okay, so great. All the best, guys, and revise. And at the end of this, again, please go back to institute materials, read the questionnaire back, and try to solve all those questions which are given in your on your website, on your online treasure and the institute website, and solve all those 80 to 100 questions to get your mastery of the topic. Okay, sure. Thanks, guys, and all the best. Well.